It's not us alone, but if you look at the other regional markets like Shanghai as well, the Chinese markets closed in with a gain of roughly about 6%, and they too have been lapping gains. Let's take this conversation across. We've got Andrew Freris as well joining in the show right now. Andrew, hi, good afternoon here. What explains this kind of a staggering move across the Chinese markets just when the world is turning away from Beijing when it comes to the manufacturing hub? One wonders what's adding to the excitement across Chinese stocks.
Well, support by the state of the markets, both in terms of words and in terms of money. And I'm extremely concerned about that because, of course, the Hong Kong market is doing extremely well. But look at my eyes. Okay, it is doing extremely well because the components, the Chinese components of the Hang Seng Index are going up. Nothing to do with Hong Kong. I have very little faith in this kind of a bull market at the middle of the time that the World Health Organization announced the single worst ever day in terms of infections. That thing is not going to go away. And the fact that China is under control, as is under Hong Kong is under control, does not mean that the rest of the world is under control. And it is ripping through the United States. And the Shanghai index is up 6% because the government put some nice news in the market. There is really very little backing it up. Okay.
Yeah, but what explains this, Andrew? Because, China is not a standalone case here, be it the US markets, be it even India, the way we've recovered from the March lows. It's a global rally led by liquidity, which is taking place. Would you say that perhaps best explains why China as well would be moving up?
No, I'm sorry, I'll beg to differ. It's not a global rally. China is up 6%. The reason being that on Monday, there has been extremely bullish state announcements that the bull market is a good thing, it should be supported. And immediately we had all the evidence of a retail, not institutional, retail bias. Now, the Chinese market can easily be driven by retail sales because they can easily account up to 40% on any day's turnover. So I said people, of course, are fed up with hearing bad news. And if the state that can influence the market comes up and says it's a good thing to buy it, they buy it. But I'm afraid this is not on the basis of fundamentals. You don't buy the stock market because you expect that it's going to go up. You buy it because you expect profitability is going to increase. You expect that the macroeconomics are going to go back online. You expect that the unemployment is going to fall. Okay, and in the case of the United States, for example, or the European Union, the economies are doing absolutely dreadfully. They're doing very poorly. So if China decides to go on its own, good luck to them. I'm not anti-Chinese. I'm simply looking very coldly here. This is business. Okay, it has nothing to do with politics and it has nothing to do with the geography. If somebody points to me at that market and saying it's going up because there has been bullish announcements, well, I would like to know what are they buying it for? What is the backing of that? And there's very little. In the case of Hong Kong, as I tell you, which the market is doing incredibly well, and the economy is doing dreadfully, and it's going to do significantly worse. The market is up because it is driven by the Chinese components of the Hang Seng Index. Well, it has nothing to do with Hong Kong.
But Andrew, put into context for us the leverage at the moment. Some reports suggest that it's actually about half what it was at the peak of 2015. And the central bank actually withdrew liquidity from the financial system on today. But on the other hand, there's still anticipation of further easing in China itself. So, the good news about the underlying stress in the economy, is it something to worry about or something that just supports the kind of gain that we're seeing on Chinese stocks right now?
Chinese government took to support its economy at the time that the lockdown did it blow it sideways. It shrunk by 6% during the first quarter, have been measured. They have not been cash, rich. Like, for example, in the case of the United States, in the case of UK, in the case of France, money was given to unemployed workers. Not so in the case of China. Again, money has been spent or has been promised to be spent primarily on infrastructure projects. Full stop. In other words, the government said, we don't care how big the fiscal deficit is, we're going to spend a lot more money. Particularly, they have a series of projects, 165 specific projects, primarily most of them, investment in technology, in artificial intelligence, in telecommunications, and in pure infrastructure. And they will spend this money. But that takes months, if not years, to drive through. So it's good news in the sense that they are not doing anything. The same thing, of course, with the People's Bank of China. Okay, it has increased liquidity in the market overall, starting from January. It has cut interest rates, okay, but no more than that. There has not been the kind of an injection in the economies we have seen in the case of the United States and in the case of the European Union, precisely because the Chinese economy did not ache and did not get hurt as much as these G3 economies were. So there is no new news, okay, to say, hey, they are just injecting X quadrillion renminbi in the market and therefore this is going to drive it up. They have done, and they are already doing it, what they said they're going to do. Measured, wise, effective, but not something that is going to sort of, you get up on Monday and suddenly Tuesday is paradise. No, it will take several months before this is percolates through.
Fair point, Andrew. In terms of foreign investor interest, do you see that waning or do you see that only building as they look towards emerging markets? Would China still be the first option for them? Before we even get to the other emerging markets, I just want to understand what the perception would be given that the mood otherwise and politically is a little China averse at the moment.
China right now is going through, let's say, a bad publicity period because of the national security and safety implementation of the law that has taken place in Hong Kong. The fact that President Trump insists that it is the Chinese that caused the coronavirus. There is no real resolution of the trade war with China, and on the contrary, the United States carries on implementing measures that divorce Chinese investment from the United States, that divorce United States investment from China. And of course, the European Union has also joined in, okay, as well as, let's say, measures that tend to push Chinese money, Chinese investment, and Chinese trade away. So China is not receiving right now good publicity. Whether one thinks it is good or bad, justified or not, is really irrelevant because that is what is actually happening. So I would not say that foreign investors are particularly interested in China right now in view of what particularly the United States has been quietly implementing. Nothing that the United States has done or said so far is new. In other words, all the things concerning investment of Chinese companies in China, the delisting of Chinese companies in the United States stock exchange, the possibility of a further implementation of the tariff war, not yet on the table, but quite potentially. All these are not bullish news for investors in equities in China.
Just wanted to get in your take as to how you're looking at the overall mood for equity markets across the globe in terms of that V-shaped recovery that everyone's talking about. But day after day, the numbers that are coming in with cases across the globe only seems to be rising at a very hectic pace. Does this in turn dent hopes for a strong V-shaped recovery in the global economy?
Read my lips. No. Okay. No, it doesn't. Okay, it means that the G3 economies, okay, in other words, Japan, European Union, and United States, are going to have more lousy news till the end of the year. The recovery, when it will start taking place, it will be slow and measured. And what I'm telling my clients when I come to look at equities, I am looking like a hawk on the labor market. I want to see the 20 million additional unemployed in the United States disappear and disappear quickly before I get bullish. And the numbers you see every now and then that they just created 2 million workplaces in the United States last month. One has to net out the fact that these might very well have been jobs that were lost because of the lockdown and they were simply regained. They are not new jobs. The same thing goes in the European Union, where they are planning to extend the subsidy of wages well into Christmas and beyond, because clearly the labor market is not returning. And if the labor market does not return back to, in inverted commas, normal, neither will the economy. Therefore, for the three major economies, okay, and for the rest of the minor major economies in the European Union, they are not good news. Same thing for Japan, and most definitely in the United States. On top of which, in the United States, we now have the uncertainty of the elections. Will Trump be elected or will not be elected? This, of course, adds. It might be good news for some parts of the market, but it might be very bad news for other parts of the market. But whereas before it was taken absolutely for sure that Trump was going to be re-elected, now there is overwhelming doubts that he will be elected at all. Never mind be re-elected. In other words, he's likely to lose the election. All these are not bullish items for the equity markets.